Are we entering a golden age of financial advice? Today's guest thinks so. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're speaking to one advisor who runs, in his words, the most efficient, inefficient advice business, and believes we're entering a golden age of financial advice. Ren, good to be with you.
Bryce, good to be with you. How could it not be good when we're entering such a golden age?
I know. Well, today we are joined by Andrew Hewison, a financial advisor and managing director of Hewison Private Wealth, where he's worked since 2002.
And in today's episode, we're going to unpack Andrew's journey in advice to becoming one of Barron's top financial advisors. We're going to talk about his process for building client portfolios, because he's certainly swimming against the tide there. Whilst a lot of the advice industry is moving towards SMAs and model portfolios, Andrew and his team are sticking strong on individually managed accounts, and so we want to pick his brain on why that is the case and what benefits he thinks he gathers.
Yes, what an episode. I cannot wait. Before we jump into today's episode, though, we would like to say a massive thank you to the launch partners of Basis Points, who, without them, we would not be able to provide free content for you. So a huge thanks goes to Orbis, Milford Asset Management, and SIBO.
And this episode has been accredited by the Financial Advice Association of Australia for CPD points. So after listening, go to the link in the show notes or the YouTube description to complete a short quiz and get your certificate. But with that said, Bryce, let's get to our conversation with Andrew.
Well, Andrew, a massive welcome to Basis Points.
Thank you very much. It's a pleasure to be here.
So we've got a lot that we want to unpack today, but we want to start with a sense of who you are and your journey in advice. So take us back to the early 2000s. What really got you interested in advice and what got you started?
For me, once the blossoming AFL footy career didn't eventuate as a teenager, I had other aspirations of moving into some kind of sport-related sort of venture. But after doing a few different things and not enjoying it so much, it just so happened that my father was a financial advisor and he's the founder of Hewison Private Wealth, and we celebrate 40 years this October. So, we just had a discussion. I sort of started to express some interest in what he did, and he said, "Look, why don't you come and check it out and come on board as an associate." I made it very clear that I had plans of travelling around the world in about 9 months' time. So he said, "Look, come and see, what you think of what we do, and if you like it, then we can talk about, a longer term plan." And I reckon after 6 weeks, I was absolutely hooked and had made a decision that this was going to be my career. And I think it had everything to do with, the client service aspect of the fact that sitting in on a meeting and seeing, my father and another advisor at the time, how they conducted themselves, and how the clients valued what they were doing for them, I could see that we could make a real difference in people's lives. So that was the clincher for me.
Who do you support in the AFL?
I'm a Carlton man. Long suffering. We're not talking about that.
There's always hope, though. Hope's eternal.
Mate, if it's not this year, we've got big problems, don't worry.
So you started there in the early 2000s.
Yes.
So much has changed between then and now. Take us through some of the biggest changes that you've seen in your time, but also what remains the same throughout all that change.
You're right. A lot has changed over that period of time. For me, I think the abolition of commissions in the financial advice or in the wealth space has been, the biggest game changer across the board. We've been working in this industry over decades to try and move it towards becoming an industry, into a profession, and conflicts of interest like that, just there's no place for them. And I think really the other huge change, which, has happened in the last decade, is the change to education standards. And I understand that there are some people that have been around the industry for a long, long time that had their noses really put out of joint. Thankfully, I had to go back to school, but it was only to do an ethics course, a bridging course, or a bridging subject. But I think they're the two real key changes. Obviously, the Royal Commission into the banking sector some years ago also Also, had wide-ranging impacts on the industry. We've made a huge amount of progress. I think, some would argue we've now probably gone, from a regulatory point of view, maybe we've gone a bit too far, but I'm still overall very supportive of the fact that, that you can't no longer become an advisor after doing a 6-week course and pretty much be put in front of clients. Like you've got to have a degree, you've got to have, other recognised post-grad designations. I think ultimately, if we're going to be the trusted advisor of a client that sits next to the lawyer and the accountant, well, why shouldn't we be as educated?
It feels like now, though, it's like the barriers, I wouldn't say are too high, but there feels like there's a severe shortage of advisors in industry. Is that right?
Yep, absolutely. And it was always going to happen. Like when you draw a line in the sand, and I'm not here to debate whether, again, I think the line was placed in the right area, but when you draw a line in the sand and say, look, you now have to be over this bar in order to continue to provide advice, then there's going to be a period of time where there's going to be a bit of a black hole left, right? Now, I would say, and if you want to become an advisor in Australia today, you are stepping into a golden age and a golden opportunity just through simple supply and demand, right? That brings so many opportunities. There was always going to be a period of time where there's going to have to be a bit of catch up. Now, are there enough people going through university and having aspirations of becoming an advisor? I'm not entirely sure. And it is in this period of time, it's to the detriment of the average Australian who might want to get advice, or you're always going to be able to get advice, but of course, supply and demand might dictate you paying more for it. I hope that takes care of itself over a period of time, but it's unfortunately the situation, I think, is one we had to have. Otherwise, you continue to have to accept a lower standard, and we don't want that.
Yeah. So on top of the regulatory changes there that you mentioned, technology has changed, new investment products have come to market. Before we started recording today, we were talking about AI and the possibilities of what that might bring to the industry.
Yeah.
Over your time, how have you found just the best ways to keep on track and keep on top of everything that's changing in the industry so you can always stay sort of close to the edge?
Look, it's not rocket science at the end of the day. You have to keep, your ear close to the ground. I think you have to continue to read into industry trends, take note of, certain industry publications, take note of pivotal podcasts. It's a huge form of media, right? Like, people don't win elections through traditional media soures these days. They get on the podcast circuit. So
as we've been trying to tell the major parties.
So all forms of media. I'm probably in a fortunate position as the managing director of Hewison Private Wealth, in that I have people around me, like a head of compliance, who while I'm very busy focused on the business and all the different elements, I've obviously got that person who is keeping their finger on the pulse as it relates to changes. Things like CPD, covers a broad range of areas, but a lot of it is industry updates and industry trends, and through membership of certain industry bodies, you would hope to get what you require to make sure that you stay up to date and on, and compliant and all those kinds of things.
So, Andrew, we want to turn to, how you think about building client portfolios at Hewison Private Wealth. And when we started preparing for this interview, we found that you really emphasised bespoke and individualised client portfolios. Why is this an important point of emphasis? And also, I would have thought whenever you go for personal advice, they would always be individual and bespoke. So how do you differ?
Well, you'd be surprised. That's the truth of the matter.
Yeah.
So when you asked me before about what we've seen change, I'm here to talk about Hewison. So this is not here to talk about how lucky are we or how good are we. I credit my father to the vision that he implemented back when he started Hewison Private Wealth, or Hewison Associates, back in the day. and again, a lot's changed, okay? But back then, commissions were rife. So it was, the reality is it was, a lot of it had to do with, well, which product provider is going to pay me the most money to recommend their product. It's a fact, right? That was an incentive. And then there was also a period of time where, people could derive and accept commissions and they didn't have to disclose the commissions, and then they didn't actually have to do any work. And we would often see back in the day, we would see clients come to us and they didn't know who their advisor was, and we would point out that that advisor's been receiving a certain amount of money over a period of time off the benefit of their portfolio. They had absolutely no idea. So when my father established Hewison's, it was always going to be, I'm going to be an independent self-licensed business. Didn't all happen on day one, but within a couple of years. And I'm going to put the client at the absolute front of every decision that this company makes. So I can sit in front of them and without any bias or not having to disclose any conflicts, I can say to them that I'm giving you my best advice that relates specifically to your goals and objectives. So long way of coming back to your question around why individually managed accounts and the like. Our view is that we want to provide absolute bespoke advice to our clients. And what that means is they sit in front of us, and I know goals-based advice is sort of a term that's been used now over the last 5 to 10 years. We've always, philosophically speaking, provided objective-based advice. So a client comes in, they sit in front of us, we understand why they're here, what it is they're looking to achieve over a period of time. We do not then risk profile them. We've never risk profiled a client in our lives. We ask a lot of risk-based questions, and obviously your statement of advice has to represent that. But we believe our job is to, without any restrictions, which is also why we don't use a platform and never have, but without any restrictions, we want to survey the landscape of all the investments that are possible, and we want to construct a portfolio that we can sit in front of the client and say, this is bespoke, it's for you, there's no cookie cutter approach here, and we believe it's going to achieve your goals and objectives.
I find that interesting because I'm going through an advice process myself at the moment. And we'd sort of had put the goals down, then had a strategy sort of put back to us with the different types of asset classes that we would go after, very, very detailed, and then a risk assessment. And it felt like, what if my risk profile came out as super low, but the strategy and the goal required pretty high risk? So I just found that process interesting, and the fact that you're saying you don't do that, it's just an objective outcome. I find and interesting.
Each to their own, right? I'm not here to say that there is what someone does out there, another advice business out there does is the wrong way. I don't have any interest in that. My only interest is we do things a particular way purely because we think that is in the client's best interest and it's going to get the outcome that they're looking for. And to that point, if their goals and objectives are super aggressive, like we're conservative by nature in terms of our approved product list and the types of investments that we're going to include, and it's pretty tight. If we can't achieve their goals and objectives using what we have available to us, and that's a conversation around their goals and objectives or whether or not we're the right advice business for them. But we're not going to, put them into a ridiculously aggressive portfolio where you're on a hiding to nothing. It's just not who we are. And I don't think many advisors are like that way inclined either. But I'd also say that because, again, there's a lot of self-licensed businesses out there, but because we're self-licensed, which is part of why we think, if you're going to be independent and have this kind of philosophy, you have to be self-licensed because you need to have that flexibility. You can't be beholden to Big Brother telling you what you need to do. And that's the way we've always been.
Yeah. It is interesting the way you explain that, because I feel like you're bucking some big industry trends in terms of real focus on efficiency. There's a trend towards like model portfolios and stuff like that, and you're doing individual portfolios. When we're researching for this, there's an industry trend towards SMAs, but you're really focused on IMAs. How do you think about, as MD, you've got to think about the amount of time your advisors are working on each client and efficiencies and overall costs. So how do you think about that approach of the bespoke offering that you're trying to offer, but also managing advisors' time and cost?
Well, I must admit, after doing this now, in this particular role for 10 years, I've been in the industry for 23. My life would be a whole lot easier if we did use SMAs. We are the most inefficient business trying to run as efficiently as possible, right?
I like that, yeah.
Right? So I've got so many friends in the industry, you meet new people and they're like, how do you do what? How on earth do you do that? But when we've been refining this sort of craft, if you want to call it that, for 40 years. And one of our key pillars, our key values is innovation. And so going back in the day, we've never used an X plan, which we all know, like 80 to 90% of the industry still use it today. We had a proprietary system, a proprietary software that we were building over many, many years, and we were adding to it, and it was everything you can imagine. CRM, compliance, portfolio construction, you name it, because it was, we knew exactly what we needed. We had a developer, contracted, so we were constantly updating it. So about 10 years ago, we realised technology was on a bit of a J curve, and now it's just gone, right? There's no way we're going to keep up with it. And we kept saying to ourselves, we're not a tech business. We're not a tech business. We tried something off the shelf, got to the very end, didn't quite work. So we've gone back to a tech stack, which, visiting the US on a few occasions and seeing how some businesses did it over there in the last 5 or 10 years. Salesforce we use, and we've got other various pieces of software that we built around it. It's all connected through APIs. So even though I just said before we're not a tech business, you can't. If innovating and wanting to improve your business and not being beholden to anyone else is in your DNA, it's very hard to move away from it. That's ultimately how we are constantly innovating to remain as efficient as possible, to continue to serve our clients the best way that we know how, whilst keeping, the cost to serve, down. And at the end of the day, if your cost to serve were blowing out and you couldn't keep it under control, then the clients are going to stop seeing the value in what they're getting for what you're charging them. And then they're going to start having, conversations about that. And thankfully, I would say we're not the cheapest in town, but we're not the most expensive. When it's something you've been doing for that long, and you can't ignore it, you can never take your finger off the pulse. So we've got annual staff conferences, we've got off-sites where we're just constantly trying to work out. And to your point earlier, technology, we are embracing all forms of technology as much as we can to continue to create efficiencies.
So Andrew, when you think about the advice process, from client coming in to actually delivering the advice, where are you actually trying to focus on, I guess, technology and innovation to free up your advice time?
Look, I think there's no doubt that because of the way that we construct portfolios, it can be very time consuming. So we've focused really heavily in recent years on how we deliver that advice. The statement of advice, being quite bespoke, is still going to take time, but it's how we've looked to utilise things like advice delivery software. So, instead of essentially putting together a piece of advice and ROA from scratch, sending it out as a PDF and then having to manage the inbox to get the approval, because we don't act with discretion, which is, I guess, is another key point of our business. We need the clients to provide their approval for everything that we recommend. We can now send that through a piece of software, and which, previous to just the sending, it enables us, it loads in the current portfolio and the target asset allocation. And it gives us, it doesn't tell us what to include on the buy side or what to sell, but it very clearly shows us where we're overweight and underweight, and the advisor can then make their changes, and then that seamlessly goes out to the client. They can accept it on their smart device and it comes back in. And for listed equities, we can now straight through process the changes. So that has been a huge game changer for us in terms of creating efficiencies for our advisors.
So one part of, I guess, building bespoke client portfolios and really individualizing them is, I guess, assessing the manager and the investment committee that you've built in-house. And we want to turn to that and ask you some questions about that, because a lot of advice businesses would rely on asset consultants and third parties rather than having an in-house investment committee. So before we get to the details about how it works, just talk to us about that from a philosophical level. Why build an investment committee in-house rather than go down some of these other routes?
So even just before I answer that, I'll quickly say that one of our other, I guess, philosophies over a long period of time is that where possible, we much prefer our clients to own direct assets. So I would say around about 75% of our client portfolios are direct ownership, particularly with Australian shares. We don't use any managers at all.
Oh, wow. Okay.
So as I said, we just prefer, look, from a control and flexibility point of view, we like to reduce the potential for decisions to get made that aren't in our clients' best interests. And managers have to make their decisions. They've got a mandate that they manage to, and that's totally fine. But they don't know what is in the best interests of the unit holders in that fund. And furthermore, when we're going through uncertain, volatile times and you've got people that are wanting to redeem units, often managers are selling things that I wouldn't want my clients to sell, and we want to be in a position to perhaps, be greedy when others are fearful and fearful when others are greedy, to use the Warren Buffett, statement. But obviously with certain markets, and I'll use the international space as a good example, Australia makes up 3% of the global economy. We do actually now, in the last 5 years or so, we actually now have direct US domiciled companies on our APL, but we also have 5 to 7 managers as well. How we select those, look, or even going back to sort of your question around the investment committee. So for a long period of time, there was probably about 6 advisors in our business, and we all sat on the investment committee. We got together on a Friday, had a planners meeting, talked about some of the changes, and we made our decisions and moved on. And as the business has grown, we've reduced that investment committee down to 4 of the Hewison owners in the business. So we're owned entirely internally within the business. So 4 of the partners make up the investment committee, and they have collectively over 75 years worth of experience, and they have a deep level of our philosophy, what we like to invest in, and we've already talked about in some areas of our business how we're a little bit unique. So I guess it's just to date it's served us very well, and we have a view that I believe that particularly as you start to deal with high net worth clients and you're competing against institutions and the like, I think they've got a knack of overcomplicating things as well. So I'm not suggesting that we won't have asset consultants in the future. We're actually looking at a couple at the moment. And maybe we might wind up having an independent chief investment officer or someone independent that sits on the committee. Never say never, but to date, even as we've broadened our knowledge base and broadened the APL into some other asset classes, we still haven't necessarily felt the need to go and bring in anyone independent into that group. But as I said, never say never.
Mm. What is the Hewison investment philosophy? What kind of drives the investment committee's decisions?
Well, the Hewison investment philosophy, just to quickly recap, is obviously IMA portfolio construction. So we don't use model portfolios in any way, shape or form. 5 major asset classes: cash, fixed interest, property, international and domestic shares. And you can fit private equity and alternatives into any of those asset classes, and we do. But when it comes to rebalancing a portfolio, they're the 5 we stick to.
Yeah.
We're strategic asset allocators. It's our philosophy. We're not tactical. We're not trying to time markets. Our belief is if we can drive a healthy return over a long period of time if we set the asset allocation according to the goals and objectives, and we every so often rebalance back to those original weightings. So without having to try and time a market, we'd like to think that we can take profits when a company or a sector's doing really well and invest into companies and sectors that aren't doing so well through that asset allocation. As I mentioned before, we do prefer direct where possible. So that kind of sets the basis for how we operate as an investment committee. We've got an investment policy which underpins everything I've just talked about. We use Morningstar as our independent research provider for equities, and over time, we've got to know, some of the sectors and some of the investments, and I'll use an example in a minute. We've got to know them pretty well to a point where we're experts in those areas, and a good example of that would be in the area of fixed interest. 60% of our portfolios, by and large, are in first secured contributory mortgages. So we've been using contributory mortgages, non-bank lenders, for 30 years. Hand on heart and touch wood, a client has never lost money in these areas. So we individually vet each mortgage, and again, we've got certain parameters that are listed in our investment policy, but we just don't believe that, for example, fixed interest should be made up of bonds and term deposits. It's just in our opinion, it's a lazy way of managing. It's low risk, but I believe if you have a deeper level of knowledge into some other areas, you can still invest in certain areas and manage the risk accordingly. So that hopefully that gives you a bit of a flavour as to how the investment committee works. And again, we, just like our clients trust us, we've developed trusted relationships with a select few managers over the journey. We've said no to 99% of what we see, but every so often a manager comes along that fits with our philosophy, and has something that makes sense for our clients, and then we're happy to put them on the APL.
Yeah, I was wondering that, you've got this philosophy of direct ownership, but I'm sure that, all the fund managers are still coming to knock on your door, and all the hot new trends, private credit, whatever it is going to be, are still trying to make the sales pitch. But I imagine because you've got this philosophy, your bar that they have to jump over is a lot higher. So talk to us about when a manager does come through, how you assess them, and for those that have jumped over the bar, what was it about them that got them there?
Top quartile performance with a long-term track record, because we're long-term investors. We're not necessarily interested in a 12-month sort of performance.
And just to interrupt there, what does long-term mean for you in that context?
5 to 10 years plus.
Performance?
Yeah.
Okay. Yeah.
Yeah. So if someone says, we've done 12% per annum since inception and it was 3 years ago, I'm probably interested in waiting another few years to see if they've got a consistency of their track record. But philosophically, we like to have a deep understanding of how they select their investments, and if it sits in alignment with the way that we construct our portfolios, perhaps more so on the domestic side, then and we're also benchmark unaware, so we're not really interested in someone that tracks the index. Like we see our portfolio management as absolute return. And then we expect theirs to be as well. I mean, in terms of, you mentioned private credit before, a lot of people would classify non-bank lending, first secured mortgages as private credit. Well, it is private credit. Yeah. So you could argue that even though it's probably been a trend over the last few years, we've actually been doing it for decades. And we do actually now have a few private credit managers on our APL, because quite frankly they make sense, and the quality of their loan book is extremely high, and there just seems to be a real, we call it an arbitrage in the market at the moment, because the banks are just shying away from anything that they don't see as bread and butter. But that's not to say that there's still not great lenders out there, corporates, etc.
Other than private credit, are there any other asset classes that you're seeing emerging in Australia at the moment, or that clients are starting to sort of demand more of?
I don't believe that our clients, by and large, our clients are incredibly trusting of us, and so they leave it to us to bring. If there was anything new that they should consider, I think they rely on us to bring it to them. in terms of trends, look, I can only speak to sort of what I see on our approved product list over the last few years, which we didn't have as much of before, and that is private equity. The whole unlisted space, I think there used to be a bit of a stigma that it was, it was a sector or a part of the alternative space which was all about non-profitable startups. And you're either going to go to the moon or you're going to lose your money. And of course they still exist. But we've been investing with a couple of managers these days over a long period of time who invest in the unlisted side of the market. But in some cases, those companies are just as big as their listed counterparts. And there are some opportunities now that we have started to see. And again, you've just got to manage the exposure within the portfolios. And we classify high net worth investors as anyone that has sort of $1.5 to $2 million and above to invest. So even taking it a bit further, I guess, if you're classified as a wholesale investor, that's a high net worth investor to us. There is opportunities for high quality private equity. And again, that's a whole nother podcast as to how you determine that. Probably need to get someone from our investment committee to come and talk about that. But there's a space for that in portfolio. So 10 years ago, I just didn't see those opportunities come across the desk at Hewison Private Wealth.
So we wanted to ask the flip side, any trends or emerging asset classes that you're wary of? And I've got to slip the crypto question in here as well.
I hadn't thought about crypto when you said that. Well, we don't invest in crypto, but we also don't invest in gold either.
Yeah.
Right.
Okay.
We like assets that are quite active, that are working for you in the portfolio. And if you're looking at crypto as a store of value, like gold, it's just not really going to form part of our asset allocation. And I guess, again, this is very, well, I would say individual. I mean, there's going to have a side of the camp either way, but we want things that are backed by fundamentals. We don't invest in the US dollar or currency, for example. We want things that are backed by fundamentals and cash flow. Well, crypto just doesn't do that for us.
Yeah.
As far as any other trends, look, the only time we're really wary, and again, it kind of comes back to kind of product construction or product manufacturing. I mean, you'll see every now and again, there'll be a theme, right? Like a thematic that has a huge run, and then all of a sudden the product manufacturers are there scurrying around trying to package something up and create something up. Less so now than, in years gone by, but, you kind of have to laugh some of that off. By the time it comes in front of you, it's typically highly structured and hard to understand, and the horse is already bolted. So, whether or not that happens in private credit, it's probably going to at some stage, but it is what it is.
So Andrew, we've got a couple of questions to close, mainly for those younger advisors who are tuning in and thinking about, their career path. What is one piece of conventional wisdom from the industry that you think is incorrect?
This is a great question, and it's always one that tests the thought process a little bit. And we manage over 800 self-managed superannuation funds, and I understand that SMSFs are not for everyone. And I would say, just to be very clear, I would say there's probably less than 5 LRBAs sitting contained within those. So they're not SMSFs structured towards property investing. It's literally, again, if control and flexibility is important to a client and maybe they've got other portfolios running in conjunction, right, we would consider an SMSF. But when you think about superannuation as an industry, I think there is a belief out there, and probably maybe it's driven by retail and industry super funds, some advisors, that your superannuation is designed to exhaust. The balance is designed to exhaust over the period of your retirement until life expectancy. When we ask that question of our clients, do you want to leave a legacy? Do you want to pass on your investment or to your next generations, or do you want to see it continue to grow? 99% of them say yes. Less than 1% would say, we don't care, it's super, we want to spend it in our retirement. So I think that conventional wisdom says that that's what it's there designed to do, which by virtue of that belief means that you're going to potentially get a pretty lazy strategy in your superannuation fund over time, and it's going to exhaust to almost be zero when you die. We don't believe that. We think if you actively manage a portfolio like that, and I'm not suggesting you focus on growth. You obviously in retirement cash flow is probably the most important thing. But if you want to offset the impact of at least inflation and have some money there on the side if you need to buy a new car or take a significant holiday without impacting the diminishing the balance over time, you need to take a more active approach to that strategy. So I think that, if hopefully that answers the question, that's just my opinion.
Yeah.
It's a good one.
Yeah. No, it's a good one. I think the next, our generation coming up and getting advice and thinking about super is, we're really one of the first generations to have super all through our working life at that, 10, 11, 12, 13%. So it's going to be a big conversation in the next few years, I imagine.
Yeah, absolutely. I mean, and that's another reason why you asked initially around young advisors coming into the industry or the shortfall. I mean, you look at the amount of money that's coming into superannuation, compulsory superannuation.
It's crazy.
The amount of people that either, they're going to rely on an industry fund or a retail fund, but one day they're going to pick up the balance and go, wow, that's my money. Yeah. Maybe I need an advisor to be guiding me through that. And that just creates more opportunity for this sector.
Yeah. It's crazy.
If anyone is listening and isn't an advisor yet, it feels like there's a good job opportunity if they want to go down that path.
Mate, honestly, it's one of the greatest things. If you're into numbers to a degree, I think a lot of people go, we hear this so often, isn't it like being an accountant? It's nothing like being an accountant, but it's and similarly accountancy is, about relationships as well, but we're in the relationship business, right? Like, yes, you have to have a pretty good knowledge of analytics and data and numbers and so on and so forth, but I wasn't a Rhodes Scholar at school, and as a relation to further maths or math methods or whatever it is. But what got me into this was the relationships, and the ability to be able to make a big difference in someone's life. So I look at that and think there's so many opportunities for people if they actually knew what being a financial advisor was really about.
And then one final question on this theme. If you could give one piece of advice to young advisors out there or people who, after listening to this, are now considering becoming an advisor, what would that piece of advice be?
I would say it's initially do your research when you're looking to apply for roles, and make sure that you ask a lot of questions about the culture of the organisation that you're talking to, and just make sure that you're aligned with the culture and the values of the business. From then, once you're in the seat, whether you're an associate and you're working to become an advisor or you're a newer advisor, I know this might sound boring, but I would just encourage people to put your head down and work hard. Keep an open dialogue with your boss, your manager, your peers about where you want to be. I find it's really not actually that difficult to stick out from the crowd these days, because a lot of people are kind of, I don't want to say they're cruising, but I just see it's not rocket science. If you really want to get ahead, it's about putting in, you don't have to do long hours. We don't profess to do long hours in our business, but work hard, ask what more you can do to be of assistance, and you'd be surprised the amount of focus and attention that you'll get in return, because we want to be as invested in our younger people as anyone, because it's in our best interests to continue on, see our clients get looked after, grow the business, whatever it might be, but that's all in the next generation. So it's a two-way street, but as I said earlier, the opportunity's never been better for someone who wants to forge a career.
Yeah, the golden age, as you coined it. So, Andrew, thank you so much for joining us. We have run out of time, but we do certainly appreciate it. For anyone listening that would like to get in touch with Andrew and the team, the website is hewison.com.au. We'll provide a link in the show notes. But absolute pleasure. Really enjoyed it.
Thanks, guys. It was likewise. Thank you.
Thanks, Andrew.
Well, that brings us to the end of today's episode. A reminder that it is accredited by the FAAA for CPD points. So go to the link in the show notes to complete a short quiz and you can get your certificate.
And a massive thank you to our launch partners who have made Basis Points possible and help us keep all of our content free. Thank you to Orbis, to Milford Asset Management, and to SIBO.